Welcome to the Finance Wisdom Summaries.
Beat the Market, a Scientific Stock Market System. Introduction. Beat the Market, a Scientific Stock Market System, by Edward O. Thorp and Sheen T. Kassouf, published in 1967, presents a groundbreaking method for consistently generating significant profits in the stock market. The authors, both academics with backgrounds in mathematics and economics, claim to have developed the first scientifically proven method for consistent stock market profits, achieving an average annual return of 25% over 5 years, even during periods of market decline and volatility. This summary will delve into the core principles of their system, focusing on convertible securities, warrants, short selling, and hedging, and provide practical applications for everyday investors. The book emphasizes that their profits are derived from both common stock and convertible securities, which include warrants, convertible bonds, convertible preferreds, puts, and calls. Their approach does not rely on predicting individual stock prices, but rather on analyzing the price relationships between these convertible securities and their associated common stocks. The minimum investment required to utilize their system was $2,000 at the time of publication, making it accessible to a broad range of investors. The authors structure the book to first recount the discovery of their system, then provide necessary background on warrants, short selling, and hedging. They illustrate the system with real-world investments and demonstrate how readers can select their own investments using the basic system. Historical performance data, including success during the 1929 crash, is also presented as proof of the system's efficacy. The book concludes with discussions on accounting, portfolio management, and the future of their method.
Chapter 1. A System is Born. This chapter recounts Sheen Kassouf's initial experiences in the stock market, highlighting his disillusionment with conventional investment approaches and the eventual discovery of the system's foundation. Kassouf's journey began in 1957, seeking investment opportunities based on brokerage house advertisements and advisory services. His early attempts, such as investing in Emerson Radio, resulted in significant losses due to market declines and the unreliability of traditional advice. Key takeaways from Chapter 1. Disillusionment with traditional methods. Kassouf's initial foray into the market, guided by advisory services and chartist theories, proved to be unreliable. He observed that even respected analysts and financial writers could not agree on the causes of market fluctuations, attributing them to a variety of factors without a consistent or verifiable basis. The circus of the market. Kassouf describes the chaotic and emotional environment of brokerage boardrooms, where investors often rely on rumors, hot tips, and a ritualistic language to cope with uncertainty. This environment, he suggests, is not conducive to rational investment decisions. The failure of fundamental analysis. Kassouf also explored the fundamental approach, which seeks to determine a stock's inherent value. However, he found that this method was also flawed, as even stocks with strong fundamentals could experience sharp declines. The future stream of earnings and dividends, which is the basis of fundamental analysis, is inherently uncertain and difficult to predict accurately. Daily application. The experiences detailed in this chapter offer a crucial lesson for the everyday investor. Be skeptical of traditional market wisdom and hot tips. The allure of quick profits can be strong, but as Kassouf's story shows, these approaches are often based on speculation and emotion rather than sound analysis. Instead of chasing trends or relying on the advice of others without question, a more disciplined and analytical approach is necessary. This chapter serves as a cautionary tale, urging investors to seek out and verify a systemic, evidence-based method for their investments, rather than being swayed by the noise and frenzy of the market.
Chapter 2. Warrants, Options on the Future. Chapter 2 introduces the concept of warrants, which are crucial to the author's investment system. It describes how Edward O. Thorp, independently of Kassouf, rediscovered the potential of warrants through mathematical analysis. Warrants are essentially options that give the holder the right, but not the obligation, to purchase a certain number of shares of a company's stock at a specified price, the exercise price, within a certain time frame. Key takeaways from Chapter 2. Definition of a warrant. A warrant is a security that allows its holder to buy a company's stock at a fixed price for a specific period. They are often issued alongside bonds or preferred stock to make them more attractive. Warrant stock diagram. The authors introduce a diagram that illustrates the relationship between warrant prices and stock prices. This diagram is fundamental to understanding how to identify mispriced warrants. 2 basic rules. The authors outline 2 primary rules governing the relationship between warrant prices and stock prices. The warrant price must always be less than or equal to the stock price. The warrant price must always be greater than or equal to its intrinsic value, stock price minus exercise price if positive. Adjusted warrants and exercise price. The concept of adjusted warrants and adjusted exercise price is introduced to account for stock splits, dividends, and other corporate actions that can affect the warrant's terms. Predictability in the stock market. The authors argue that the predictable relationship between warrants and their underlying stocks provides a scientific basis for profiting in the market, unlike the speculative methods discussed in Chapter 1. Daily application. For the everyday investor, understanding warrants and their relationship to common stock can open up new avenues for investment, though it requires careful study. The key takeaway is the importance of understanding the underlying mechanics of any investment vehicle before committing capital. Instead of blindly following tips or market sentiment, one should seek to understand the mathematical and logical relationships that govern asset prices. Practically, this means due diligence. Before investing in any complex financial instrument, thoroughly research its structure, risks, and how its price is determined. Don't invest in what you don't understand. Look for discrepancies. The authors emphasized that the predictable relationship between warrants and their underlying stocks provides a scientific basis for profiting in the market, unlike the speculative methods discussed in Chapter 1. This principle can be generalized. Always look for situations where the market might be mispricing related assets. This requires a deep understanding of how different financial instruments are interconnected and how their values should theoretically align. Analytical approach. The chapter advocates for an analytical rather than emotional approach to investing. By understanding the mathematical rules that govern warrant prices, investors can make more informed decisions and avoid the pitfalls of speculative trading. This applies to all investments. Base your decisions on data and logical reasoning, not on fear or greed.
Chapter 3. Short Selling. Profits in Bad Times. Chapter 3 introduces the concept of short selling, a crucial component of the author's strategy for profiting in declining markets. Short selling involves borrowing a security, in this case a warrant, and selling it with the expectation that its price will fall. If the price does indeed fall, the short seller can buy back the security at a lower price, return it to the lender, and pocket the difference as profit. This strategy allows investors to profit from downward price movements, providing a counterbalance to traditional long positions. Key takeaways from Chapter 3. Concept of short selling. Short selling is the practice of selling securities that you do not own, with the intention of buying them back at a lower price in the future. This allows investors to profit from a decrease in the price of a security. Selling warrants short. The authors specifically discuss selling warrants short. Given the predictable relationship between warrants and their underlying common stock, overvalued warrants can be a highly effective strategy. The avalanche effect. This chapter introduces the concept of the avalanche effect, which describes how a small initial price movement in a stock can trigger a larger, more rapid decline in the price of its associated warrant, amplifying potential profits or losses from short selling. Daily application. While short selling can be a complex and risky strategy for individual investors, the core principle discussed in this chapter has broader applications beyond just financial markets. Understanding risk and opportunity in downturns. The ability to profit from declining markets highlights the importance of seeing opportunities where others see only losses. In any aspect of life, understanding how to navigate and even benefit from challenging situations can be a powerful skill. For example, during an economic downturn, while many businesses struggle, some innovative companies might thrive by offering solutions to new problems or by acquiring assets at lower prices. Hedging and risk management. The idea of short selling, when combined with long positions, as will be discussed in later chapters on hedging, introduces the concept of risk management. In personal finance, this could mean diversifying investments to protect against downturns in a single asset class. In business, it might mean having contingency plans for worst-case scenarios or diversifying revenue streams to reduce reliance on a single product or market. Critical thinking about good times. The chapter implicitly encourages a critical perspective on seemingly prosperous times. Just as a stock can be overvalued, leading to a potential short-selling opportunity, situations in life or business that appear too good to be true often carry hidden risks. Developing the ability to identify potential weaknesses or vulnerabilities, even in seemingly strong situations, can prevent significant losses. Chapter 4. The Basic System. This chapter introduces the core concept of the author's investment strategy, hedging. Hedging, in this context, involves simultaneously holding a long position in a common stock and a short position in its associated warrant, or vice versa, to profit from predictable price relationships while minimizing risk. The authors present this as a method for achieving high profits with low risk, a stark contrast to the speculative approaches discussed earlier. Key takeaways from Chapter 4. 1. Hedging for high profit, low risk. The fundamental idea is to create a hedged position where the potential gains from one side of the trade, for example, the stock, are balanced by potential losses from the other side, for example, the warrant, or where the predictable mispricing between the two assets allows for consistent profit. 2. Changing the mix. The authors explain that the optimal mix, or ratio, between the number of shares of stock and warrants in a hedged position can change over time. This dynamic adjustment is crucial for maintaining the low-risk, high-profit nature of the system. 3. Deeper insight into the basic system. The chapter delves into the mathematical and logical underpinnings of why this hedging strategy works. It's not about predicting market direction, but exploiting predictable relationships between related securities. 4. Preview of the basic system. This section provides a glimpse into the practical application of the system, setting the stage for later chapters that will detail how to identify candidates and execute trades. Daily application. The concept of hedging, as presented in this chapter, has profound implications beyond financial markets, offering valuable lessons for risk management and strategic decision-making in everyday life. 1. Risk mitigation in personal decisions. Just as the system hedges against market volatility, individuals can apply a similar mindset to personal and professional decisions. For example, when considering a career change, one might hedge by taking on a part-time role in the new field while maintaining their current job, reducing the financial risk of a full leap. Or, when making a significant purchase, researching and comparing multiple options acts as a hedge against making a poor choice. 2. Diversification of effort and resources. The idea of changing the mix can be applied to how we allocate our time, energy, and resources. Instead of putting all your eggs in one basket, diversify your efforts. For instance, a student might not only focus on academic excellence, but also develop extracurricular skills or networking, hedging against the sole reliance on grades for future success. An entrepreneur might diversify their product offerings or target markets to reduce dependence on a single revenue stream. 3. Exploiting inefficiencies or opportunities in daily life. The basic system thrives on exploiting predictable relationships and inefficiencies in the market. In daily life, this translates to being observant and analytical about situations where there might be an imbalance or an overlooked opportunity.
For example, if you notice a consistent pattern of inefficiency in a process at work, developing a solution to streamline it could lead to significant benefits. Or identifying a recurring need in your community that is not being met could be an opportunity to create a valuable service. 4. Strategic planning, not just prediction. The core of the basic system is not about predicting the future, for example, whether the market will go up or down, but establishing a position that profits regardless of the direction, as long as the relationship between the assets holds. This is a powerful lesson for life. Instead of trying to perfectly predict outcomes, focus on creating strategies that are robust and adaptable to various scenarios. For instance, when planning for retirement, instead of trying to predict market highs and lows, focus on a diversified portfolio that can withstand different economic conditions.
Chapter 5, The System in Action, $100,000 Doubles. Chapter 5 provides concrete examples of the basic system in action, illustrating how the authors, specifically Thorpe, applied their strategy to achieve significant returns. The chapter details several case studies, most notably the molybdenum story, where the systematic application of hedging with warrants led to substantial profits. This section moves from theoretical explanation to practical demonstration, showing the system's effectiveness in real-world market scenarios. Key takeaways from Chapter 5. Real-world application and success. The chapter highlights actual investment scenarios, such as the molybdenum story, where the basic system was successfully implemented. These examples serve as empirical evidence of the system's profitability and low-risk nature. Molybdenum story. This detailed case study demonstrates how a hedged position involving molybdenum stock and its warrants was managed to generate considerable returns. It illustrates the dynamic adjustments made to the hedge as market conditions changed. Consistent profitability. The examples underscore the system's ability to generate consistent profits even in volatile markets by exploiting the predictable relationships between convertible securities and their underlying stocks. Doubling capital. The chapter title itself, $100,000 Doubles, emphasizes the significant returns achievable through the systematic application of the hedging strategy. Daily application. The practical examples in this chapter offer valuable lessons beyond financial investment, emphasizing the power of systematic execution and disciplined application of a proven strategy. The power of a proven system. Just as the author's system consistently generated profits, applying a well-researched and tested system to any endeavor can lead to predictable and positive outcomes. Whether it's a fitness routine, a learning methodology, or a business process, a systematic approach often outperforms sporadic, unorganized efforts. For example, if you want to improve your health, instead of trying random diets or exercises, follow a structured plan designed by experts. Discipline in execution. The success stories in this chapter are not about luck, but about disciplined execution of the system. This translates to everyday life as the importance of sticking to a plan, even when faced with challenges or temptations to deviate. Consistency and adherence to a well-thought-out strategy are often more important than raw talent or initial enthusiasm. For instance, achieving a long-term goal like learning a new language requires consistent daily practice, not just occasional bursts of effort. Learning from case studies. The detailed molybdenum story provides a template for analyzing and understanding how a strategy plays out in real time. In any field, studying successful case studies can provide invaluable insights and practical knowledge that theoretical understanding alone cannot. This could involve analyzing successful marketing campaigns, effective problem-solving approaches in your profession, or even successful personal habits of individuals you admire. Adaptability within a framework. While the system is systematic, the authors also discuss changing the mix, indicating an adaptability within the defined framework. This teaches us that even rigid systems need flexibility to adjust to changing circumstances while staying true to core principles.
In personal life, this might mean having a budget, a system, but being flexible enough to adjust it for unexpected expenses or opportunities. In business, it means having a strategic plan, but being agile enough to pivot when market conditions change.
Chapter 6. How to use the basic system. Chapter 6 transitions from demonstrating the system's effectiveness to providing practical guidance on its implementation. It outlines the steps an investor needs to take to identify suitable warrants, select short sale candidates, and construct a hedged portfolio. This chapter is essentially a how-to guide for applying the basic system, making it accessible for readers to begin their own investments. Key takeaways from Chapter 6: Identifying listed warrants. The chapter provides instructions on how to find and identify warrants listed on financial exchanges, which is the first step in applying the system. Picking short sale candidates. It details the criteria for selecting warrants that are good candidates for short selling, often those that are overvalued relative to their underlying stock. Using the warrant stock diagram. The importance of the warrant stock diagram is reiterated, serving as a visual tool to assess the relationship between the warrant and stock prices and identify potential hedging opportunities. Choosing the mix. Guidance is given on determining the optimal ratio of warrants to common stock for a hedged position, emphasizing that this mix can vary and needs to be carefully calculated. Capital allocation and protection. The authors discuss how to divide capital among different hedging candidates and how to ensure adequate protection against adverse price movements. Summary of the basic system. The chapter concludes with a concise summary of the basic system, consolidating the key steps and principles for easy reference. Daily application. This chapter, focused on practical application, offers valuable lessons for anyone looking to implement a strategy or system in their daily life, whether it's financial, professional, or personal. A systematic approach to decision-making. The detailed steps for identifying and selecting investment candidates highlight the importance of a systematic approach to complex decisions. Instead of making impulsive choices, break down the decision into smaller, manageable steps, each with clear criteria. For example, when buying a car, create a checklist of features, budget, and research different models systematically before making a choice. When making a career move, gather information about the industry, company culture, and job responsibilities systematically. Data-driven selection. The emphasis on using the warrant stock diagram and specific criteria for short sale candidates underscores the value of data-driven decision-making. In everyday life, this means relying on facts and evidence rather than intuition or hearsay. Before making a significant purchase, research product reviews and compare specifications. Before making a career move, gather information about the industry, company culture, and job responsibilities. Understanding ratios and proportions. The concept of choosing the mix and capital allocation can be applied to resource management in general. Whether it's time, money, or effort, understanding how to allocate resources effectively to achieve a desired outcome is crucial. For instance, when planning a project, allocate resources, time, budget, personnel, proportional to the importance and complexity of each task. Continuous adjustment and optimization. The system's need for dynamic adjustment of the mix teaches the importance of continuous monitoring and optimization. No plan is perfect from the start, and situations change. Regularly review your strategies and make adjustments as needed. For instance, in personal budgeting, regularly review your spending habits and adjust your budget to align with your financial goals. The value of a summary or checklist. The summary of the basic system at the end of the chapter emphasizes the utility of having a concise overview or checklist for complex processes. For any recurring task or important decision, creating a simple checklist or summary of key steps can help ensure consistency and reduce errors. This could be a morning routine checklist, a project management checklist, or a pre-travel checklist.
Chapter 7. Further Proof, the Historical Record.
Chapter 7 provides historical evidence to validate the effectiveness of the basic system. The authors present data demonstrating the system's performance over an extended period, including its resilience during significant market downturns like the 1929 crash. This chapter aims to build confidence in the system by showing its consistent profitability across various market conditions, reinforcing the idea that it is a scientifically proven method rather than a speculative gamble. Key takeaways from Chapter 7. Historical performance. The chapter presents a detailed analysis of the basic system's performance over a 17-year period, 1946 to 1966, showing an average annual gain of more than 25% after commissions but before taxes. This long-term track record is crucial for establishing the system's credibility. Resilience during market crashes. A significant point highlighted is the system's ability to generate profits even during severe market downturns, specifically demonstrating how an investment could have doubled during the September 1929 to 1930 stock market crash. This counterintuitive success during a bear market underscores the hedging aspect of the strategy. Simplified mechanical strategy. The authors suggest that the system can be implemented as a simplified mechanical strategy, implying that its success does not rely on complex market timing or subjective judgment, but rather on adherence to a set of rules. Potential future for the basic system. While presenting historical data, the chapter also touches on the future potential of the system, suggesting its continued applicability. Daily application. The historical proof presented in this chapter offers valuable lessons for decision-making and strategy in everyday life, emphasizing the importance of evidence, resilience, and long-term perspective. Evidence-based decision-making. Just as the authors rely on historical data to prove their system, it's crucial to base important decisions in life on evidence and past performance, rather than mere assumptions or hopes. Before adopting a new habit, a new business strategy, or even a new educational approach, look for data or case studies that demonstrate its effectiveness over time. Building resilience in personal and professional life. The system's ability to profit during market crashes teaches the importance of building resilience. In personal finance, this means having an emergency fund, diversifying investments, and avoiding excessive debt, which can help weather economic downturns. In professional life, it means developing diverse skills and maintaining a strong network, making one more adaptable during career challenges. Long-term perspective over short-term fluctuations. The 17-year performance record emphasizes the power of a long-term perspective. In any endeavor, short-term setbacks or failures are inevitable. Focusing on consistent, disciplined effort over an extended period, rather than being discouraged by immediate results, is key to achieving significant success. For example, when learning a new skill, don't get discouraged by initial difficulties. Focus on consistent practice and improvement over months or years. The value of a robust strategy. A strategy that performs well in both good and bad times is inherently robust. This principle can be applied to personal planning. Create plans that are flexible enough to adapt to unforeseen circumstances rather than rigid plans that might break under pressure. For instance, a robust health plan includes not just diet and exercise, but also stress management and adequate sleep, making it more sustainable in the face of life's challenges.
Chapter 8. More on warrants and hedging. Chapter 8 expands on the discussion of warrants and hedging, delving into more nuanced aspects and variations of these financial instruments and strategies. It explores different types of warrants beyond the standard listed ones, such as over-the-counter, regional, and Canadian warrants, and provides deeper insights into the factors that determine their prices. The concept of reverse hedging is also introduced, offering another dimension to the system. Key takeaways from Chapter 8. Types of warrants. The chapter broadens the scope of warrants to include those traded over the counter, in regional markets, and in Canada, indicating that the principles of the system can be applied to a wider range of opportunities. Determinants of warrant prices. A more detailed analysis of what influences warrant prices is provided,
going beyond the basic stock-price relationship to include factors like time to expiration, volatility of the underlying stock, and interest rates. What is a warrant worth? This section likely elaborates on the theoretical valuation of warrants, providing a framework for investors to determine if a warrant is underpriced or overpriced relative to its fair value. Reverse hedging. This is a significant new concept, where instead of buying stock and selling warrants, one might buy warrants and sell the underlying stock short. This strategy is employed when the warrant is undervalued relative to the stock, allowing for profit from the convergence of their prices. Spotting candidates for reverse hedging. The chapter provides guidance on how to identify situations where reverse hedging might be profitable, focusing on specific market conditions or mispricings. Daily application. This chapter, with its deeper dive into financial instruments and strategies, offers valuable lessons applicable to everyday decision-making, particularly in understanding value, recognizing opportunities, and adapting strategies. Understanding intrinsic value and market price. The discussion on what is a warrant worth highlights the critical distinction between an asset's intrinsic value and market price. In daily life, this means looking beyond the superficial price tag of things, products, services, even opportunities, and understanding their true underlying value. For example, a cheap product might have a low market price, but also low intrinsic value due to poor quality or short lifespan. Being able to spot these hidden gems can lead to significant personal or professional gains. Recognizing undervalued opportunities. The concept of reverse hedging, where one profits from an undervalued warrant, teaches the importance of identifying and acting on undervalued opportunities in various contexts. This could be an undervalued skill you possess, an overlooked talent in a team member, or a niche market that is underserved. Being able to spot these hidden gems can lead to significant personal or professional gains. Flexibility and adaptability in strategy. The introduction of reverse hedging demonstrates that a successful system is not rigid but adaptable. When conditions change or new opportunities arise, one must be willing to adjust their approach. In personal goal setting, if your initial strategy isn't working, be open to trying a different approach while still aiming for the same goal. In business, this means being agile and willing to pivot your strategy based on market feedback. Beyond the obvious. Exploring over-the-counter and regional warrants encourages looking beyond the most obvious or mainstream options. In life, this translates to exploring alternative solutions, unconventional paths, or niche markets that might lead to unique advantages or discoveries. Don't limit yourself to what everyone else is doing. Sometimes the greatest opportunities lie off the beaten path. Continuous learning and deepening expertise. The detailed analysis of warrant price determinants underscores the value of continuous learning and deepening one's expertise in a chosen field. The more you understand the intricate factors that influence a situation, the better equipped you are to make informed decisions and identify complex opportunities. This applies to any profession or hobby. The more you learn, the more sophisticated your strategies can become.
Chapter 9. Can anything go wrong? Chapter 9 addresses potential risks and challenges that could impact the effectiveness of the basic system. While the authors present a robust and scientifically proven method, they acknowledge that no investment strategy is entirely risk-free. This chapter explores various scenarios that could lead to difficulties or losses, providing a realistic perspective on the system's limitations and how to mitigate them. Key takeaways from Chapter 9. Short squeezes. A significant risk discussed is the short squeeze, where a rapid increase in the price of a shorted security forces short sellers to buy back shares to cover their positions, further driving up the price and leading to substantial losses. This highlights the importance of careful selection of short sale candidates and continuous monitoring. 1929 again. The chapter revisits the possibility of extreme market events, such as a repeat of the 1929 crash, and discusses how the system would perform under such conditions. While the system is designed for resilience, extreme volatility can still pose challenges. Volatile price movements.
Beyond crashes, general volatile price movements can make it difficult to maintain optimal hedges and execute trades at favorable prices. This emphasizes the need for quick decision-making and efficient execution. Extension of warrant privileges. Changes in the terms of warrants, such as extensions of their exercise period or adjustments to the exercise price, can alter their value and impact the profitability of a hedged position. Banning of short sales. The possibility of regulatory changes, such as a ban on short sales, is considered as a potential threat to the system, as short selling is a fundamental component of the hedging strategy. Extensive use of the basic system. The authors also ponder whether widespread adoption of their system could diminish its effectiveness, as increased participation might reduce the mispricings that the system exploits. Daily application. This chapter, by focusing on potential pitfalls, offers crucial lessons in risk assessment, contingency planning, and adaptability, applicable to any aspect of life. Proactive risk assessment. The most important lesson is the need to proactively identify and understand potential risks in any plan or endeavor. Before embarking on a new project, a career change, or even a significant personal decision, consider what could go wrong and how likely those scenarios are. This foresight allows for better preparation. Contingency planning. Knowing what could go wrong is only half the battle. The other half is having a plan for when it does. The discussion of short squeezes and market crashes underscores the importance of contingency planning. In personal finance, this means having an emergency fund, insurance, and diversified investments. In project management, it means having backup plans for critical tasks. Adaptability to changing conditions. The potential for changes in warrant privileges or regulatory environments highlights the need for adaptability. No plan is static. Successful individuals and organizations are those that can adjust their strategies in response to new information or unforeseen circumstances. This could mean learning new skills, changing career paths, or adjusting business models. Understanding systemic risks. The question of whether widespread adoption could diminish the system's effectiveness introduces the concept of systemic risk, risks inherent in the broader environment. In everyday life, this could be understanding how economic trends, technological shifts, or societal changes might impact your personal or professional goals and planning accordingly. The limits of any system. Even a scientifically proven system has its limits. This chapter teaches humility and the understanding that no strategy guarantees absolute success or eliminates all risk. It encourages a realistic outlook, acknowledging that while preparation and a sound strategy can significantly improve outcomes, some factors remain beyond control. Chapter 10. The General System. The Evaluation of Convertible Securities. Chapter 10 significantly expands the scope of their system beyond just warrants to encompass the broader category of convertible securities. This chapter demonstrates the versatility and general application of their analytical framework, showing how the same principles used for warrants can be applied to convertible bonds, convertible preferred stocks, call options, and put options. This generalization allows investors to identify hedging opportunities across a much wider range of financial instruments.
Chapter 10. The General System. The Evaluation of Convertible Securities. Chapter 10 significantly expands the scope of the author's system beyond just warrants to encompass the broader category of convertible securities. This chapter demonstrates the versatility and general applicability of their analytical framework, showing how the same principles used for warrants can be applied to convertible bonds, convertible preferred stocks, call options, and put options. This generalization allows investors to identify hedging opportunities across a much wider range of financial instruments. Key takeaways from Chapter 10. The scope of convertibles. The chapter defines and categorizes various convertible securities, including convertible bonds, convertible preferred stocks, call options, and put options, explaining their fundamental characteristics and how they relate to their underlying common stock.
The anatomy of a convertible bond. A detailed explanation of convertible bonds is provided, including their features, conversion ratios, and how their value is influenced by both interest rates, like a bond, and the underlying stock price, like an equity. Applying the basic system to other convertibles. The core insight is that the same mathematical and logical principles used to identify mispricings and create hedges with warrants can be extended to these other convertible securities. Examples like reverse hedging with Collins radio warrants, likely referring to a convertible bond or similar instrument, illustrate this application. Finding best candidates for hedging. The chapter provides guidance on how to identify the most promising hedging opportunities among the broader universe of convertible securities, emphasizing the importance of analyzing their price relationships with the underlying common stock. Puts, calls, and the basic system. The inclusion of put and call options demonstrates the comprehensive nature of the system, showing how these widely used derivatives can also be incorporated into the hedging strategy. Daily application. This chapter's focus on generalizing a successful system to a broader domain offers powerful lessons for problem-solving and strategy in everyday life. Generalizing solutions. The most significant lesson is the power of generalizing a successful solution or framework. If you develop an effective method for solving a particular problem, consider how that same method, or its underlying principles, can be applied to other, seemingly different problems. For example, if you find a successful strategy for managing your personal finances, consider how those principles, budgeting, saving, investing, can be applied to managing a small business budget. Understanding interconnectedness. By analyzing various convertible securities and their relationship to common stock, the chapter highlights the interconnectedness of different elements within a system. In life, this means recognizing how different aspects of your life, e.g. health, work, relationships, finances, are not isolated but influence each other. A problem in one area might have roots or solutions in another. Expanding your toolkit. The chapter encourages expanding one's toolkit of strategies and instruments. Just as investors can use various convertible securities, individuals can benefit from learning diverse skills, tools, and approaches to tackle different challenges. The more versatile you are, the more opportunities you can seize and the more resilient you become. Systematic evaluation of opportunities. The emphasis on evaluating different convertible securities to find the best hedging candidates translates to systematically evaluating opportunities in life. Instead of jumping at the first option, take the time to understand all available choices, their pros and cons, and how they align with your overall goals. This applies to career choices, educational paths, or even major purchases. Complexity from simplicity. The system, while dealing with complex financial instruments, is built upon fundamental principles. This teaches that even complex problems can often be broken down into simpler, understandable components, and that robust solutions often stem from a deep understanding of basic principles. Don't be intimidated by complexity. Seek to understand the underlying fundamentals.
Chapter 11. Deciphering your monthly statement. Chapter 11 focuses on the practical aspects of managing an investment account within the framework of the author's system. It guides the reader through understanding the various components of a monthly brokerage statement, which is crucial for accurately tracking investments, calculating profits and losses, and ensuring the correct application of the hedging strategy. This chapter demystifies the accounting side of investing, making the system more accessible to individual investors. Key takeaways from Chapter 11. Understanding brokerage accounts. The chapter explains the different types of brokerage accounts relevant to the system, including cash accounts, margin accounts, and short accounts. Each type has specific rules and implications for how trades are executed and recorded. Cash account. This account is used for straightforward purchases and sales of securities, where the investor pays the full amount for their purchases. Margin account. A margin account allows investors to borrow money from their broker to purchase securities, which can amplify both gains and losses. Understanding margin requirements and interest charges is critical for the hedging strategy, as it often involves leveraging positions. Short account. This account is specifically for short selling, where borrowed securities are sold. The chapter explains how short positions are recorded and managed on the statement. Calculations in a mixed account. The authors detail how to perform calculations in accounts that combine long and short positions, as well as cash and margin transactions. This is essential for accurately assessing the performance of hedged positions. Applicability to the basic system. The chapter emphasizes how a thorough understanding of the monthly statement directly supports the effective operation of the basic system, enabling investors to monitor their hedges and make timely adjustments. Daily application. This chapter, while seemingly technical, offers valuable lessons on financial literacy and meticulous record-keeping that extend far beyond stock market investments. Financial literacy is empowerment. The core message is that understanding your financial statements, whether from a brokerage, bank, or credit card, is crucial for financial control. Just as investors need to decipher their monthly statements to manage their hedges, individuals need to understand their personal finances to make informed decisions about spending, saving, and debt. This empowers you to take control of your financial future. Meticulous record keeping. The detailed explanation of account types and calculations highlights the importance of meticulous record keeping. In personal finance, this means tracking your income, expenses, and investments accurately. For small business owners, it means maintaining precise accounting records. Good record keeping is the foundation for sound financial management and allows for accurate assessment of your financial health. Understanding leverage and risk. The discussion of margin accounts introduces the concept of leverage. While leverage can amplify returns, it also amplifies risk. In everyday life, this translates to understanding the risks associated with borrowing money for any purpose, whether it's a mortgage, a car loan, or student-led. Always assess your ability to repay and the potential consequences of increased debt. Regular financial review. The monthly statement implies a regular review process. Just as investors should review their brokerage statements monthly, individuals should regularly review their personal financial situation. This could involve reviewing bank statements, credit card bills, and investment portfolios to ensure accuracy, identify discrepancies, and track progress towards financial goals. The importance of details. The chapter stresses the importance of understanding the fine print and details of financial transactions. In any contract or agreement in daily life, whether it's a rental agreement, an employment contract, or a service agreement, paying attention to the details can prevent future misunderstandings or financial pitfalls. Chapter 12, Portfolio Management. Chapter 12 delves into the broader aspects of managing an investment portfolio within the context of the author's system. It discusses strategies for exploiting both rising and declining markets, the role of diversification, and the importance of managing multiple accounts to optimize long-term gains. This chapter moves beyond individual hedged positions to consider the overall structure and management of an investor's capital. Key takeaways from Chapter 12. Exploiting market movements. The chapter explains how to adjust the hedging strategy to exploit both a rise and a decline in the price of the common stock. This involves dynamically managing the ratio of warrants to stock to maximize profits in different market conditions. Diversification. The authors discuss the concept of diversification, not just across different securities, but potentially across different types of hedging strategies or even different brokerage accounts. This helps to spread risk and optimize returns. Managing multiple accounts. The idea of having several accounts, example, different brokerage firms or types of accounts, is introduced, which can offer advantages in terms of risk management, access to different types of securities, or optimizing tax implications. Long-term gains. The chapter emphasizes the focus on long-term gains, reinforcing that the system is designed for consistent, sustainable profitability rather than short-term speculation. Daily application. The principles of portfolio management discussed in this chapter are highly applicable to managing various aspects of daily life, from personal finances to career development and even personal well-being. Strategic resource allocation. Just as investors allocate capital across different securities, individuals manage their resources, time, energy, money, skills, across various life domains. This chapter encourages a strategic approach to resource allocation, ensuring that resources are deployed where they can generate the greatest long-term returns, whether it's investing in education, health, or relationships. Adapting to changing environments. The ability to exploit both rising and declining markets highlights the importance of adaptability. In life, this means being able to adjust your strategies and plans based on changing circumstances. For example, in a challenging job market, you might focus on skill development and networking, while in a booming market, you might pursue more aggressive career advancement opportunities. Don't put all your eggs in one basket, whether it's your income source, your social circle, or your hobbies. Diversification beyond finance. The concept of diversification extends beyond financial investments. In career, it means developing a diverse skill set to make you more resilient to industry changes. In personal well-being, it means diversifying your activities to include physical, mental, and social pursuits, ensuring a balanced and fulfilling life. Long-term vision. The emphasis on long-term gains encourages a long-term perspective in all aspects of life. Instead of focusing on immediate gratification, consider the long-term consequences and benefits of your decisions. This applies to saving for retirement, building a strong relationship, or pursuing a challenging long-term project. Managing multiple accounts in life. The idea of managing multiple accounts can be metaphorically applied to different areas of your life. For example, you might have a health account, a relationship account, and a career account, each requiring different investments and strategies. Effectively managing these various aspects of your life contributes to overall success and well-being.
Chapter 13, Why We Are Sharing the Secret. Chapter 13 addresses the natural question of why the authors would choose to share a seemingly profitable and exclusive investment system. This chapter delves into their motivations, dispelling notions of altruism or a desire for widespread adoption that might dilute the system's effectiveness. Instead, they offer pragmatic reasons for disclosing their methods, primarily rooted in the academic and scientific pursuit of knowledge and the challenges of convincing a skeptical financial establishment. Key takeaways from Chapter 13. Skepticism and disbelief. The authors faced significant disbelief and skepticism from the financial community when they initially presented their findings. The idea of a scientifically proven method for consistent stock market profits was met with resistance as it challenged conventional wisdom and established practices. Desire for personal control. One of the motivations for sharing the secret is the author's desire for individuals to be able to implement the system themselves. This suggests a belief in empowering the individual investor rather than keeping the knowledge exclusive to a select few. Threat of rediscovery. The authors acknowledge that given the mathematical and logical basis of their system, it was only a matter of time before someone else independently rediscovered it. By publishing their findings, they secure their intellectual claim and contribute to the academic discourse. Academic and scientific integrity. Underlying their decision is likely a commitment to the scientific method and the dissemination of knowledge. As academics, their goal is to advance understanding, and sharing their proven system aligns with this principle. Daily application. This chapter offers profound insights into the dynamics of sharing valuable knowledge and the challenges of innovation applicable to various aspects of life. Overcoming skepticism with evidence. The author's experience with disbelief highlights the importance of presenting strong, verifiable evidence when introducing new ideas or challenging established norms. In any field, whether it's proposing a new project at work, advocating for a different approach in a community, or even sharing a personal belief, Backing your claims with data and demonstrable results is crucial for gaining acceptance. Empowering others through knowledge. The desire for individuals to implement the system themselves speaks to the power of empowering others through shared knowledge. Instead of hoarding expertise, teaching and enabling others to apply valuable insights can lead to broader positive impacts. This applies to mentorship, open-source contributions, or simply sharing best practices within a team. The inevitability of progress and innovation. The acknowledgement of the threat of rediscovery underscores the idea that truly valuable and logical systems will eventually be discovered regardless of whether their originators choose to keep them secret. This encourages a mindset of continuous innovation and adaptation, as any competitive advantage based on a logical system is likely to be temporary. The value of contribution. The act of sharing their secret can be seen as a significant contribution to the investment community and to the broader understanding of financial markets. This reminds us that contributing to a larger body of knowledge or to the well-being of a community can be a powerful motivator and a source of lasting impact, even if it means giving up an exclusive advantage. Integrity and transparency. By openly discussing their motivations and the potential downsides, the authors demonstrate integrity and transparency. In any relationship or professional setting, being transparent about your intentions and acknowledging potential downsides builds trust and credibility.
Chapter 14: What the Future Holds. In the final chapter, the authors reflect on the future implications and potential scalability of their scientific stock market system. They consider how much capital can be effectively invested using their method, both by individual investors and by the entire system collectively. This chapter looks forward, contemplating the broader impact and longevity of a strategy built on exploiting predictable relationships in financial markets. Key takeaways from Chapter 14. Scalability of the system. The authors address the question of how much capital can be invested in the basic system without diminishing its effectiveness. This touches upon the concept of market efficiency and whether widespread adoption of a profitable strategy could eliminate the very inefficiencies it exploits. Total investment capacity. They consider the theoretical maximum amount of capital that could be invested by the entire system, suggesting that while individual opportunities might be limited by market size, the overall potential is substantial. A general solution for the stock market. The chapter hints at the possibility of their method representing a more general solution for understanding and profiting from the stock market, moving beyond specific instruments to a fundamental understanding of market dynamics. Long-term vision. The discussion implicitly reinforces the long-term viability of a scientific analytical approach to investing, contrasting it with speculative or trend-following strategies. Daily application. This concluding chapter offers forward-looking lessons on the sustainability of strategies, the impact of widespread adoption, and the pursuit of fundamental solutions, applicable to various aspects of life. Sustainability of strategies. Just as the authors consider the scalability of their investment system, it's important to evaluate the long-term sustainability of any strategy you adopt in life. Will a particular diet, exercise routine, or work habit remain effective and feasible over time? Or will it eventually hit diminishing returns or become unsustainable? Focus on building habits and systems that can endure. Impact of widespread adoption. The question of whether widespread use could diminish the system's effectiveness is a crucial one. In any competitive field, whether it's a business strategy, a personal development technique, or even a parenting approach, if everyone adopts the same successful method, its unique advantage might erode. This encourages continuous innovation and the search for new, effective approaches. Seeking general solutions. The idea of a general solution for the stock market encourages us to look for fundamental principles in overarching solutions in our own lives. Instead of solving each problem in isolation, can you identify underlying patterns or root causes that, if addressed, would provide a more general and lasting solution? For example, instead of just treating symptoms of stress, address the underlying causes through lifestyle changes. Continuous evolution and adaptation. The future-oriented discussion implies that even a robust system needs to evolve. Markets change, and so do life circumstances.
This reinforces the need for continuous learning, adaptation, and refinement of our personal and professional strategies to remain effective and relevant in a dynamic world. The power of fundamental understanding. Ultimately, the book suggests that a deep scientific understanding of underlying principles, whether in finance, health, or relationships, provides the most enduring advantage. Superficial tactics may offer short-term gains, but true mastery and long-term success come from grasping the fundamental forces at play.
Main idea of the book. Beat the Market presents a revolutionary, scientifically backed investment system focused on exploiting predictable price relationships between convertible securities, like warrants, convertible bonds, and options, and their underlying common stocks. Rejecting speculative approaches and traditional market wisdom, authors Thorpe and Kassouf demonstrate how a disciplined strategy of hedging, simultaneously holding long and short positions in related assets, can generate consistent, high profits with significantly reduced risk even in volatile or declining markets. The core insight is that by understanding and leveraging mathematical relationships rather than predicting market direction, investors can create robust portfolios. The book advocates for a rigorous analytical approach to investing, emphasizing due diligence, adaptability, and continuous learning to identify and capitalize on market inefficiencies for long-term financial success.
If you enjoyed the content, please consider supporting the author.
Thanks for watching, and if you like this video, subscribe. Now, let's go to the next video.